Picture this scenario. You stop working after 40 decades of diligent labor. You finally possess the opportunity to unwind, time for vacations, time to relish your existence. And then, half a year later, you get a notice from the IRS. Your pulse begins thumping as you unseal it. The document claims you owe $8,400 in fines for a concept titled Failure to Take Required Minimum Distributions. You have zero clue what that signifies. You never received a caution. You never received a prompt. And now, the IRS is insisting on funds with added interest. You scan the document once more. Your palms are trembling. You performed everything correctly. You banked your whole career. You obeyed the workplace laws. You settled your dues annually. So how is this possible? How could you owe thousands of bucks in fines for a duty you never even realized existed? This is not some bad dream. This is occurring to thousands of seniors across America right now. And it might happen to you if you do not identify the 10 tasks the IRS expects the second you retire. Segment 2. The Setup and Reassurance Greetings and Welcome. My name is Edward. I am a Lead Policy Analyst and Retirement Wealth Specialist. And I have dedicated years assisting seniors just like you navigate the intricate statutes that control your Social Security, your annuity, your IRA, and your filings. Every single week, I speak with elders who are puzzled, frightened, and stressed by IRS notices they do not comprehend. And today, I want to ensure that never occurs to you. In this clip, I am going to guide you through 10 particular steps the IRS demands when you retire. These are not elective. These are not tips. These are national mandates. And if you skip even one of them, you could encounter fines, interest levies, and massive unforeseen tax invoices. But here is the positive news. Every single one of these mandates is entirely manageable if you know the process. And I am going to reveal exactly the process, bit by bit, in simple talk, utilizing only formal state materials. But I need you to do one favor for me. Remain until the very finish of this clip, because near the end, I am going to expose the single most perilous blunder retirees commit in their initial year of leisure. A blunder that can cost you tens of thousands of dollars in needless levies. And most folks have no clue they are committing it. Are you prepared? Let us start. Segment 3, the Robert Trapp story. I want to recount a story about a person named Robert. Robert is 73 years of age. He resides in Pennsylvania. He served for 42 years as a power engineer. He was prudent with his cash. He put into his 401k every single pay period. He amassed a retirement fund worth nearly $480,000. He also possessed a minor annuity from his firm, and he had been collecting Social Security since age 67. Robert finished working in March of 2024. His firm threw him a farewell gala. His colleagues wished him luck, and Robert departed home feeling gratified. Gratified by what he had reached, gratified by the fund he had constructed. He felt protected. But Robert made one vital error, an error that would cost him significantly. When Robert finished, nobody informed him regarding required minimum distributions. Nobody informed him that once he hit 73, the IRS mandated him to pull a certain sum from his IRA every single year. Robert thought his cash could just remain there, expanding, waiting for him to utilize it when he required it. That is what he had been told for decades. Let your retirement fund expand. So that is precisely what Robert did. He left the funds alone. He survived on his annuity and Social Security, and he did not access his IRA. Months passed by. Robert was joyful. Retired existence was fine. And then, in February of 2025, Robert got a notice from the IRS. The notice said he had neglected to pull his required minimum distribution for 2024. The sum he was meant to withdraw was $17,200, and because he did not pull it, the IRS was applying a fine. The fine was 25% of the sum he should have pulled. That is $4,300. Robert was horrified. He had no clue this statute even existed. He instantly phoned his wealth manager. The manager confirmed it. Yes, Robert was mandated to take the payout. Yes, the fine was legitimate. And yes, Robert still had to pull the $17,200 and settle taxes on it, plus the fine. Robert felt nauseous. He had performed everything correctly his whole career. He had banked prudently. He had settled his dues promptly. He had never been in friction with the IRS. And now, because of one statute he did not know about, he owed nearly $5,000 in fines. Robert's tale is not rare. In fact, it is painfully frequent. And I am stating this today, not to frighten you, but to be absolutely certain you never find yourself in Robert's place. Because the reality is, Robert could have prevented this entirely. If he had identified the statute, if he had initiated action promptly, if someone had merely described to him what the IRS mandated. So let me do that for you right now. Segment 4, the official facts breakdown. Let us commence with the basics. The IRS has very particular demands when you stop working, and most of them are never truly described to seniors. So I am going to divide them for you, one by one, using only formal IRS and Social Security Department data. Here are the 10 tasks the IRS expects the second you retire. Requirement number 1, you must begin pulling required minimum distributions from your IRA at age 73. This is the statute that ensnared Robert. According to the IRS, you usually have to start pulling funds from your IRA, simple IRA, SEP IRA, or pension plan fund when you hit age 73. These withdrawals are titled Required Minimum Distributions, or RMDs. You must pull your RMD by December 31st annually, but here is where it becomes complex. For your initial RMD, the year you reach 73, you have a choice. You can pull it by December 31 of that period, or you can delay until April 1st of the next year. But if you delay until April 1st, you will have to pull 2 payouts in one single year, your initial RMD and your second RMD. That signifies double the billable earnings in 1 year, and that can shove you into a higher tax tier. So my tip, pull your initial RMD by December 31st of the year you reach 73. Distribute the tax load over 2 years rather than 1. And one more detail. This statute does not apply to Roth IRAs while you are breathing. Roth IRAs do not possess mandated minimum distributions. Only classic IRAs, SEP IRAs, simple IRAs, and 401k funds. Requirement number 2. You must actively coordinate tax withholding on your annuity and IRA payouts. This is one of the largest jolts for seniors. During your career years, your boss automatically removed taxes from your pay. You did not have to ponder it. But in retirement, tax removal does not happen automatically. You have to solicit it. If you do not provide a document titled Form W-4P to your annuity manager, they will remove taxes as if you are single with 0 tweaks. That might be far too high or far too low. For IRA payouts, the standard removal rate is 10%. But for many seniors, 10% is not nearly sufficient. If you are in the 22% tax tier and only 10% is being removed, you will owe a massive bill in April. So here is what you must perform. Reach your annuity manager. Reach your IRA manager. Solicit them for Form W-4P or Form W-4R. Complete it. Select the removal percentage that fits your actual tax tier and file it. Do not assume it will occur automatically. It will not. Requirement. Number 3. You must conclude whether to remove taxes from your Social Security checks. Here is a fact that jolts most seniors. Roughly 40% of folks who get Social Security must settle federal income taxes on their checks. This occurs if you possess other significant income, like an annuity, IRA payouts, or stock income. The IRS utilizes something titled combined income. to decide if your Social Security is billable. Combined income is your adjusted gross income, plus any tax-free interest, plus 1/2 of your Social Security checks. If your combined income as a loan filer is over $25,000, up to 50% of your Social Security might be billable. If it is over $34,000, up to 85% might be billable. For wedded pairs filing together, the limits are $32,000 and $44,000. Now here is the hurdle. The Social Security Department does not automatically remove taxes. You have to solicit it. You can ask them to remove 7%, 10%, 12%, or 22% of your monthly check. To perform this, you can complete Form W-4V, Voluntary Withholding Request. You can file it digitally through your My Social Security portal, or you can post it to your local Social Security branch. If you do not perform this and your Social Security ends up being billable, you will owe the IRS a lump amount when you lodge your return, and that can be a very harsh shock. Requirement number 4, you may be mandated to perform quarterly estimated tax payments. This is a major one. The IRS functions on a pay-as-you-go model. That signifies you are meant to pay dues throughout the year, not all at once in April. When you were career active, your boss managed this through paycheck removal. But in retirement, if your removal is not sufficient to cover your tax debt, you must perform estimated tax payments every quarter. Here is the statute. You must perform estimated tax payments if you anticipate owing at least $1,000 in tax after removing your withholding and perks. And your removal must cover at least 90% of your current year tax, or 100% of your previous year tax. If your earnings were over $150,000 last year, you need to pay 110% of your previous year tax. Estimated tax payments are required 4 times a year: April 15th, June 15th, September 15th, and January 15th of the following year. If you skip these cutoffs, the IRS will bill you underpayment fines, even if you are owed a rebate when you lodge your return. So if you have stock income, house income, or large IRA payouts, consult a tax expert. Determine if you need to perform estimated payments. And if you do, utilize Form 1040-ES to compute the amount and perform your payments promptly. Requirement number 5. If you transfer your 401k or IRA, you must perform it within 60 days. When you retire or switch roles, you might want to shift cash from your 401k to an IRA, or from one IRA to another. If you take the cash as a payout with the goal of placing it into another fund later, you have exactly 60 days to finish the transfer. If you skip that 60-day cutoff, the entire amount becomes a billable payout. And if you are under age 59 and a half, you will also owe a 10% early pull fine. But here is the even larger snare. If you take the payout as a check addressed to you, the IRS mandates your fund manager to remove 20% for taxes. So if you take a $50,000 payout, you will only get $40,000. To finish a total transfer, you must place the entire $50,000 into the new fund within 60 days. That signifies you have to find the missing $10,000 out of your own wallet. If you only place the $40,000 you got, the $10,000 that was removed is seen as a billable payout. So here is what you should perform instead. Solicit a direct transfer. That signifies the cash moves directly from your old fund to your new fund. You never handle it. No removal, no 60-day cutoff, no hazard. Always pick the direct transfer choice. Requirement number 6. You must grasp whether your annuity is billable. Many seniors think their annuity is tax-free because they previously paid into it for years. That is not how it functions. According to the IRS, your annuity or pension checks are fully billable if you have no after-tax capital in the deal. What does that signify? It signifies if your boss made all the payments and you never paid any after-tax cash, then your annuity is 100% billable. If you did pay after-tax cash, then part of your annuity is tax-free. But you need to identify which part. Your annuity manager should offer you data about your cost basis, the amount you paid after tax. That amount will not be taxed again. But everything else is billable as regular income. Do not think your annuity is tax-free. Verify with your annuity manager, obtain the facts, and coordinate your removal accordingly. Requirement number 7. If you access cash from your IRA before age 59 and a half, you may owe a 10% early pull fine. If you retire early, before age 59 and a half, and you begin taking cash out of your IRA or 401k, you will usually owe a 10% fine on top of regular income tax. So if you pull $30,000, you will owe income tax on that $30,000. Let us say 22%, which is $6,600, plus a 10% fine, which is $3,000. That is a total tax invoice of $9,600, nearly 1/3 of your payout. But there are caveats. If you become fully and permanently infirm, no fine. If you arrange substantially equal periodic payouts after leaving the job, no fine. If you have been diagnosed by a doctor as terminally ill, no fine. If you meet one of these caveats, you can escape the fine, but you must lodge Form 5329 with your return to declare the caveat. Do not just think the IRS will identify it, you have to inform them. Requirement number 8. You must disclose all retirement payouts on your tax filing. Every time you access cash from your IRA, 401k, or annuity, you will get a document titled Form 1099-R. This document shows how much you pulled and how much tax was removed. You must disclose this on your tax filing, even if you are past age 73 and pulling mandated minimum payouts. Even if the full amount was removed for taxes, you still have to disclose it. And if you get Social Security, you will get a Form SSA 1099. That also must be disclosed. Do not skip these documents. Do not assume the IRS already identifies it and you do not have to disclose it. You do. Every payout must be disclosed on Form 1040 or Form 1040 SR. Requirement number 9, you must hit the quarterly estimated tax cutoffs. I cited this before, but it is so vital I am going to state it again. The year is split into 4 payment windows for estimated taxes: April 15th, June 15th, September 15th, January 15th. If you owe estimated taxes and you skip one of these cutoffs, the IRS will bill you a fine for that quarter, even if you pay extra in the following quarter, even if you are owed a rebate when you file. The fines are computed separately for every window, so tag these dates on your calendar, set prompts, and pay promptly. Requirement 10. You must keep your beneficiary tags current. This one does not touch your taxes directly, but it can have catastrophic results for your heirs. When you started your IRA or 401k, you picked a beneficiary. That beneficiary tag dictates who gets the cash when you pass. It does not matter what your testament says. The beneficiary tag cancels your testament. If you got a divorce and never fixed your beneficiary document, your ex-partner could get your whole IRA. If your partner passed and you never fixed the document, the IRA may go to your estate instead of your offspring. And here is the tax result. Under current statute, most non-spouse heirs must drain an inherited IRA within 10 years. That is titled the 10-year rule. It applies to IRAs inherited after December 31st, 2019. If your grown offspring inherit your IRA, they must pull the whole balance within 10 years, and every dollar they pull is billable income. If they wait until year 10 and pull it all at once, they could face a massive tax invoice. So please, check your beneficiary tags, ensure they show your current desires, and talk to your heirs about the 10-year rule so they can coordinate accordingly. Those are the 10 tasks the IRS expects the second you retire. Let me recap them fast. 1. Start pulling mandated minimum payouts at age 73. 2. Actively coordinate tax removal on your annuity and IRA. 3. Conclude whether to remove taxes from Social Security. 4. Perform quarterly estimated tax payments if mandated. 5. Transfer retirement funds within 60 days or use direct transfers. 6. Grasp whether your annuity is billable. 7. Know the early pull fine statutes if you retire before 59 and a half. 8. Disclose all payouts on your tax filing. 9. Hit quarterly estimated tax cutoffs. 10. Keep your beneficiary tags current. Now let me provide you 3 particular action moves you can take this week. Segment 5. The Action Plan. 3 steps, very well. Here is your 3-move action plan. These moves will shield you from IRS fines, surprise tax invoices, and pricey errors. You can initiate today. Let's go. Step 1. If you are 73 or senior, check your mandated minimum payout, sum, and cutoff. Call your IRA manager, the bank, firm, or fund house that holds your IRA. Ask them, what is my mandated minimum payout for this year? By statute, they must either inform you the sum or offer to compute it for you. They are mandated to mail you this data by January 31st annually. If you have not got it, call them. Obtain the exact sum, obtain the cutoff, and pull the payout promptly. If you have several IRAs, you can pull the total RMD from one fund or divide it among them. But if you have a 401k or 403b, you must pull the RMD separately from every fund. Do not speculate. Do not delay. Call today. Step 2. Solicit tax removal documents from every channel of retirement income. Create a list of every channel of cash you have in retirement: Social Security, annuity, IRA payouts, 401k payouts. For each one, reach the payer and solicit the correct removal document. For Social Security, solicit Form W-4V or tweak removal through your My Social Security portal online. For annuities and regular IRA checks, solicit Form W-4P. For one-off IRA or 401k payouts, solicit Form W-4R. Complete these documents. Select a removal percentage that fits your tax tier. If you are not certain what that is, consult a tax expert. File the documents and keep records for your files. This one move can shield you from massive surprise tax invoices in April. Step 3. Build an IRS online portal and check your tax payment status every quarter. Go to IRS Gov account. Build your free IRS online portal. Once you are in, you can observe your current debt owed, all payments you have performed, your estimated tax payments, your tax records, payment plan choices if you owe cash. Verify this portal every quarter. Ensure your estimated payments are being logged. Ensure your removal is on target. If you see an issue, fix it instantly. Do not wait until April. This portal gives you live insight into your tax status, and it is free. Utilize it. Let me give you a fast recap. Step 1. Check your RMD sum and cutoff if you are 73 or senior. Step 2. Solicit tax removal documents from every channel of retirement income and file them. Step 3. Build an IRS online portal and track your tax payments quarterly. Perform these 3 moves, and you will escape the snares that trap thousands of seniors every single year. Segment 6. The Community Call to Action. Before I let you depart today, I want to share a very vital thing with you. Something that extends past just this one clip. The statutes that control your retirement, your IRA, your Social Security, your taxes, shift constantly. The age for mandated minimum payouts just shifted from 72 to 73. Tax tiers shift, removal statutes shift, Social Security statutes shift, and often, by the time most seniors hear about these shifts, it is too late. They have already committed the error. They have already missed the cutoff. They have already triggered the fine. YouTube alerts are useful, but they are not sufficient. The system does not always present you every clip. An alert might not arrive, and a vital statute shift could occur, and you might not hear about it for months. That is why I want to personally invite you to join our Global Senior Alerts official WhatsApp portal. This is not a group chat. You will not be flooded with texts. It is a one-way formal alert portal where we post you live updates the second vital statutes shift for seniors. We track Social Security payment shifts, Medicare and insurance plan updates, IRS and annuity tax statute shifts, banking laws that touch seniors, and TSA flight rules. And right now, when you join the portal, you will get a free gift. It is titled the Senior Benefits Protection Guide. This guide contains everything we spoke about today. The 10 IRS tasks at retirement, described in simple talk. A checklist of documents you need to solicit. The quarterly estimated tax cutoffs. How to verify your RMD. How to arrange tax removal. And how to escape the most common pricey errors. This guide is yours entirely free, just for joining the portal. The link is in the text box below this clip. Click it now before you exit this page, because I do not want you to neglect it. And if you found today's clip useful, please distribute it. Distribute it with your partner. Distribute it with a pal who just retired. Distribute it with a peer who is stressed about taxes. Because here is the reality. The data I shared with you today resides in IRS papers. It is on formal state websites. It is openly accessible, but nobody ever sits with a senior and describes it clearly. In simple talk, with real case studies and real action moves, that is what I am here to perform. I am Edward, and my vow to you is basic. Every clip I produce will be based on proven facts from formal state data only. No rumors, no fear tactics, no hype, just the reality, clearly described, so you can make certain knowledgeable choices about your retirement. Thank you so much for viewing today. Please click the link in the text box to join the Global Senior Alerts official WhatsApp portal and obtain your free Senior Benefits Protection Guide. Follow this channel if you have not yet, and leave me a note below. Tell me, did you identify all 10 of these IRS tasks before today? Or was this the first time you heard about some of them? I read every note, and your input helps me identify which themes to cover next. Look after yourself, shield your retirement, and I will see you in the next clip.